Welcome to the Money Talks Decoding Finance YouTube channel, where it's all about destigmatizing the conversation around money and building wealth. Allow me to bring you Money Talks every Sundays. Hey, what's up, y'all? My name is Harpreet Gill. Welcome back to my channel, Money Talks, where we decode all things finance. Today's topic is about mortgages. This is such an important topic, especially if we're thinking about home ownership or getting into real estate. One of the most important things to discover before you actually go into your real estate journey is really discovering how much you get qualified for a mortgage. How does a mortgage work? How do you pay it off? All the intricacies, and we're here to dive right into that. And I wanted to bring this topic because I remember when I was going to my journey just to, thinking about home ownership and things like that, the first thing that I thought to myself was, I need to save up for my down payment. And that's all I was focused on. And when I sat down with my realtor, he told me that I need to figure out how much I get qualified for a mortgage. And what I thought I was going to get qualified for versus what reality happened was two completely different things. I thought I was so sure that I was going to get qualified for at least $400,000. But to my surprise, I only got qualified for 230. And I think this is one of the most common mistakes that a lot of new homeowners make, because we don't realize that we actually have to start figuring out how much we get approved, because you don't have a budget until you know what you get qualified for. And today I have a very special guest who's going to help me dissect and understand this topic of mortgages. And his name is Matt Daoud from BMO Bank of Montreal. Matt, thank you so much for being here with me today and sharing your insight about mortgages, because I know you've been doing this for a very long time. And I'm so excited to kind of dissect this topic and just get right into it. But before we get started, I would love for you to let us know, who is Matt? How did you get into mortgages? When did this start? And just let us know a little bit about yourself.
Hi, Harpreet. First of all, thank you so much for inviting me to join you. It's a pleasure. I've been in banking for over 33 years, right out of university. So I graduated from York University with a Bachelor of Business Administration, worked in different jobs at the bank. And then I've been in working as a mortgage specialist since 1997. So I've been over 20 years in mortgages, and I'm really excited to shed some lights on answering any questions you have about mortgages.
Amazing. You've been in the industry for a long time. You said 20 years. To me, if you've been in the industry for that long, you definitely are an expert on the topic. So I'm so glad to have you share some of your wisdom and knowledge around this topic. But I just want to get right into it. What is a mortgage and how does it work?
So a mortgage is basically a loan to help customers buy a home. So anything that is related to home financing is a mortgage. And it's probably buying a home. It's the most important purchase in anybody's life. And we're so excited to be able to help customers achieve their dreams in buying their homes.
Absolutely. And so when it comes to a mortgage, can you explain what some of the terms mean? I know we hear amortization often, we hear term, we hear fixed, we hear variable. Would you be able to kind of break down some of those concepts for us?
Yes, I would love to. So amortization is basically how long it would take to pay the mortgage off in full. So most common amortization is 25 years. That means you pay off your mortgage in 25 years. If you put more than 20% or 20% or more, then you can go up to 30 years amortization. That's how long it takes you to pay off your mortgage.
Right.
Then there's a term. The term is how long your interest rate is guaranteed for. So for example, 5 years fixed is how long your interest rate is guaranteed. It's guaranteed for 5 years. And then after the 5 years, you go to your financial institution and you renegotiate your rate and you get a new term. So the term is how long your mortgage rate is guaranteed for. Amortization is how long it takes you to pay off your mortgage.
Right. So question, you said that amortization is the entire duration that it takes you to pay off your mortgage. So let's just say I want to buy a house and I want my amortization to be 20 years. But 2 years into my home, once I've actually purchased it, I realized that, you know what, I actually want to pay off my house in 10 years. I want to change my amortization period. Is that something that you can actually do during the process of when you do have your home?
Yes. Once you have your mortgage, it's set. So at the beginning, let me go back a little bit. So if you put down payment 20% or more, you can go up to 30 years amortization. If you put less than 20%, then the maximum amortization period is 25 years. Right? It's called a high ratio mortgage. The maximum is 25 years amortization. The longer the amortization, the lesser the mortgage payments. The shorter the amortization, the higher the mortgage payments. Having said that, in the middle of the term, how you can reduce your amortization, or in other words, pay off your mortgage quicker, is by using the prepayment options. So you can use, at BMO, we have what is called 20 plus 20. So you can make a 20% lump sum prepayment, or up to 20%, during any calendar year. And you can also increase your monthly payment by another 20%. You can do both. So by doing that, you reduce your amortization. So in other words, you pay off your mortgage quicker and you pay less interest. Also, you can reduce your amortization or change your amortization at the end of the term. So at the end of your interest, at the end of your term, let's say at the end of the 5 years, then you can change your amortization and you can reduce it or increase it at the end of the term.
Okay. So I know that you said that you can have an amortization period up to, like, let's say 30 years if you wanted to. I want the consumer to understand that when you have a longer amortization period, your monthly payments actually get smaller. But at the same time, although the payments get smaller, you're paying interest for a longer period of time. So you've paid more interest over that 30-year period, as opposed to somebody who might have their amortization at 25 or 20 years.
That is exactly correct. So it comes down to affordability.
Right.
If you put 20% or more, then sometimes you choose to go 30 years amortization, so you can afford a larger mortgage, because we, as we said in the beginning, the longer the amortization, the lesser the monthly payments. So it would help you to qualify for a larger mortgage if you go 30 years. However, at a cost that you're now extending your mortgage to pay it off in 30 years, so you're paying more interest, obviously. However, if it's not, it doesn't, if you can afford with no problem 25 years amortization or even less, then for sure it's advisable to go that route, so you can pay off your mortgage quicker.
Yes, absolutely. And it's so important that I think somebody sits down with a financial professional that really is able to kind of take a look at your overall situation, because then we can help to determine whether or not you need a longer period. Because although, yes, you'll be paying more interest, it might be more suitable for your situation at the current time, versus somebody who is looking to pay it off sooner, right? So it obviously, this advice is, not general to any one specific situation. This is just general education that we want people to get familiar with the concepts and the terms of what a mortgage is, how it works, but it's not direct to any one particular person. So I just wanted to kind of make that clear, that we're not giving advice. If anybody's looking for advice, if you're looking to understand what's the best option, I would really highly suggest that you contact me. My information is below this video, and I can definitely help you understand where you're at and what we need to do to figure out what's the best option for mortgages, and connect you to Matt, who is the expert. But one thing that I kind of wanted to talk about is, I remember when I was going through my journey of, kind of figuring out what a mortgage is, thinking about home ownership and stuff like that. And there was just so much new language that I was never introduced to before, obviously. And one of the things that came up was, are you planning on getting an open mortgage or a closed mortgage? And I was like, what is that? I don't even know what that is. And I would love for you to kind of touch on that for us.
Yeah, I would love to. So there are different terms. Um, most of the terms that we hear about, so there's closed mortgages and open mortgages, but most of the terms that that we hear about is actually closed mortgages. But there are two types of closed mortgages. There is a fixed mortgage and a variable mortgage. Right. So what a fixed mortgage is it's an interest rate that you are guaranteed for whatever period of time, which we call term. That interest rate will be guaranteed. It will not go up or down during that period. So if you go a 5-year fixed, and right now we're at all-time lows in interest rates, so you're guaranteed that interest rate for a period of 5 years. So it's peace of mind. You don't have to worry about it. However, in the past 10, 15 years, a lot of people did very well. A lot of customers did very well taking a variable rate. So what a variable rate is it's based on prime rate, and it's whatever the discounting from prime. But it goes up and down with prime rate. So when rates were higher, it was ideal to go variable, because then you're taking advantage of an interest environment that is low and going lower. However, when rates this down, probably you have both options, but probably it's advisable to go fixed rate, so you have peace of mind and you guaranteed your rate will not change during the term.
Okay. Is there any time, I know this might be a hard question to answer, but is there any time that you would suggest fixed over variable or variable over fixed, or is it really just depending on the consumer's comfortability?
Yeah. I mean, the customer has to decide. However, I will always advise customers upon what is the interest rate environment we're in. What is the view? Nobody knows for sure. I wish we had crystal balls of knowing where rates are going. However, absolutely, having said that, if we foresee that interest rates are going to go lower, then it is better to go variable rate, because your rate will go down with prime rate. Right. However, if we think that interests are going up in the next year or two, then it's best to go fixed rates. That's number one. Number two, it depends. Are you planning to keep your house for a long time, or you're planning to sell it in a year or two? If you're planning to sell, then I would also advise customers to go with variable rates. The reason being is the penalty. If you go variable term, then the penalty is, if to break a mortgage, is always guaranteed to be 3 months interest. Right. Penalty. So 3 months interest penalty. However, if you go fixed rate, then the penalty is usually higher. And it's with most banks, it is the greater of 3 months interest, or what is called an interest rate differential, which is calculated at the time when you decide to break your mortgage. Right. So this is the difference. Where the interest rates are going, we decide in which way you go. And also, if you're planning to sell your home and break your mortgage, then it's also that's a factor, if whether you go fixed or variable.
Okay. So remember, guys, obviously this really depends on each person's situation, whether you're getting fixed or variable interest. That's something that we could sit down and discuss. And, it really is dependent on the consumer. Every situation is different. That's why it's so important to get a personal financial needs analysis completed, so that way we can help you discover what the best option is for you. And also, we're going to talk about penalties, but we have to understand that there comes penalties with any sort of contract. When it comes to the financial services industry, we need to make sure that we are comfortable taking on something that potentially has costs associated to it when you break a penalty, because a lot of times what happens is when people are not fully educated, they discover what they need in the process of when they already have received something. And then they're like, well, you know what? I don't want to do this. But then you also have to remember, at that time, penalties are also something that play a role. So it's so important to understand beforehand, as opposed to trying to educate yourself after you already have a product. This is something I think a lot of people want to know about. And I know for myself in particular, I don't want to have a mortgage for a very long time. I want to have a mortgage for maybe 5 to 10 years maximum. And even 10 years for me, I think is pushing it. But I'm always thinking about how can I go and pay off my mortgage faster. Now, when I learned the difference between an open and a closed mortgage, I also knew that when you have a closed mortgage, that you can only put up to a certain amount at the end of a year. If you have open, you might be able to put more. Would you kind of be able to explain a little bit more detail what that really means?
Sure. So in an open mortgage, it's actually completely open. So you can pay any amount. You can pay down your mortgage by any amount at any time without any penalty. However, for open mortgages, usually the interest rates are quite higher, substantially higher than the regular closed mortgages. But you can pay it off at any time. In closed mortgages, whether it's variable closed or fixed closed, it depends on your bank. What are the prepayment options? So with BMO, what I explained before is 20 plus 20. So you can pay down your mortgage each calendar year by paying either lump sum, not either, it's actually both, by paying a lump sum of up to 20% during any calendar year. So if you start off with a mortgage, for example, of a 500,000 mortgage, then 20% of that is 100,000. So you can pay your mortgage down by up to 100,000 a year during a calendar year, with increments of $100. So it doesn't have to be 100,000. If you save, let's say, $2,000-$3,000, you can put it towards your mortgage with no penalty. Also, you can increase your monthly payment by another 20%. So if you're paying $2,000 a month, 20% of that is $400. So you increase your monthly payment from $2,000 to $2,400. In both cases, that additional money that you put towards the mortgage goes 100% towards the principal. So you reduce your amortization period. And as you said, the Harpreet, you pay off your mortgage much quicker in that case.
Okay, perfect. And just one last thing I want to kind of touch on is something that I had discovered during my journey is that at the end of a term, you can dump in more money towards the principal of your home before you renew your term. Is this correct? Can you elaborate a little bit more on that?
That's exactly correct, Harpreet. So at the end of the term, so if you're in a 3-year term, a 4-year term, a 5-year term, whatever your term is, whether fixed or variable, when you're up for renewal, the mortgage becomes fully open. So you can pay your mortgage down by any amount you want without paying any penalty.
Okay, perfect. So this next question I think is something that a lot of people need to know or want to know. But what are some of the criteria that you look for when someone is applying for a mortgage? What are some of the documentations that somebody has to have? What's that process look like?
Terrific question. So the banks look, first of all, for mainly, like we look for more things, but mainly for 3 things. We look for income, down payment, and credit. So these are very important to determine how much mortgage the customer is qualified for. In terms of income, it depends on your situation. Are you a salaried employee on payroll or are you self-employed? So if you're a salaried employee, we would ask for 2 recent pay stubs plus either a letter of employment or the previous year T4 slip. That's if you're a salaried employee. If you're self-employed, then we will ask for the last 2 years T1 general, which is your income tax return for the previous 2 years, and we take the average for the 2 years, plus your notice of tax assessment, which is the document you receive back from the government after you file your income tax. And also that if you are incorporated, then we will ask you for the last 2 years notice to reader business financial statements. So we will look for the business financial statements for the self-employed person as well. And then we take the 2 years average for the income for the self-employed. For salary, we just look at the pay stubs and the letter of employment or the T4 slip.
Okay, so when it comes to your income that you're looking at over the last 2 years, are you looking at the net income or the gross income?
For self-employed, when we look for the last 2 years average, we look at the net income after expenses. So I'd like to be a little bit more specific. So line 150 on your T1 general or your NOAs, the income that self-employed people should be looking for. That's the income that the bank will most likely use. However, if you're, for example, a sole proprietor, then we will gross up your income by 15%. So for example, a customer that is making 50,000 a year, the last 2 years average,
Right.
we will gross it up by 15% for only for a sole proprietor, and that would be for 57. Will include 57,500, for example, in that case. But if you're incorporated, we don't gross up the income. However, for customers that leave some income, net income in their businesses, at some time or sometimes we're able to add some of that net income that is left in the company back to their net income, so they can qualify for a bit more, because we know that they can draw it down from the company, from the business, anytime they want, because there's positive net income in the company.
Right. Okay, so there you guys go. For if you're a self-employed person, your income is going to be determined if you're applying for a mortgage after all your expenses. So if you've earned $50,000 in your business, but you have $30,000 of expenses, then you're going to be looking at $20,000. So be very careful as a self-employed individual, when you are in that phases of buying your first home, to really speak to an accountant to understand how much it is that you're going to write off, because what is left over is what the banks are looking at. As for somebody who's employed, obviously it's your gross income, which looks a lot different when it comes to the qualifications and how much you are going to get approved for. So one of the things I know that is taken into consideration when we're looking at whether or not you get approved for a mortgage is your debt to income ratio. And, I hear often, and I thought this myself, because, we get taught that don't worry about your student loans. It's good debt. It's not going to affect your ability to buy a house. How true is that, Matt?
Harpreet, all debts are included in the debt servicing ratio that the banks use. So including obviously your student loan as well. How it works is there are two ratios that all the banks use. The first one is called gross debt service ratio, GDSR, and total debt service ratio, TDSR. So in both banks, your maximum, and the GDSR is a calculation that we take into consideration the mortgage monthly payment,
Right.
The property tax and heat, and we divide that by your income. So that ratio cannot exceed 39% of your income. So the mortgage payment, the property tax, and the heat cannot exceed 39% of your income. At BMO, we're a little bit, we have a little bit more room, so we're a little bit more flexible. So we can go up a little bit on that ratio, sometimes up to 45%. So that gives you room to qualify for a lot more, for a lot larger mortgage. Then the other ratio is, towards your question, is the total debt service ratio. The total debt service ratio includes also your mortgage monthly payment, your property tax and heat, but then it includes all your other debts. It includes all credit cards, loans, leases. So that ratio, student loans, obviously, so that ratio cannot exceed, with most banks, 44% of your income. With us, we're a little bit more flexible at BMO. We can allow, depending on each situation, up to just under 50% of your income. Again, so to your point, student loans, credit cards, line of credits, it all goes towards a calculation, how much you qualify for, and the higher the debt, the lesser you qualify for the mortgage.
I'm so glad that you were able to touch on that, because I think a lot of us do get told that that's something that we shouldn't have to worry about. Student loans, it doesn't play a big role in our ability to, purchase a house in the future. And clearly what you have just said, it does make a difference, because it is calculated into your total debt ratio. And so if you, let's just say, for example, when I graduated from school, I had about $32,000 of debt, but my job was paying me $50,000 a year. And that right there would have been already a determining factor whether or not I get approved for a mortgage, or how much I get approved, because my debt was past that 50% ratio comparison to what I'm earning. So, and student debt is one of those things that many of us carry around. We get sold this dream that it's one of the best form of debts out there, and it doesn't really affect too much of your lending criteria. But clearly, you have just stated that it does.
Yeah, and sometimes each person is different. So with some customers, I actually would tell them maybe you're better off to pay off your debts, whether it's a student loan or credit card or any other loan, and reduce your down payment by that amount. Sometimes that's better for the customer. So by paying off the debt and eliminating your debt, um, and if you have the money, if you have the extra cash to do that, then that's great. If you have the extra savings, that's great. However, if you don't, sometimes it's probably better to reduce your down payment, take that amount from your down payment and pay off your debt. A lot of times that works better for the customer. So it's each situation is different. So by talking to you, talking to me, we'll be able to help the customers determine what's best for them in their own situation.
Yes. So there you go. You heard that right here from our mortgage specialist. You want to reduce as much debt as you possibly can when you get into home ownership. It is not easy to maintain a home. The hardest part is to maintain it, right? Because anything can happen. And you want to make sure that you're not drowning in other forms of debt while you're maintaining your home, because it is one of the greatest things that you can purchase. It's probably the most expensive thing that you're going to purchase in your lifetime. And you want to make sure that you put yourself in a position where you don't end up lapsing your mortgage and potentially losing your house. Because I, for at least myself, know that I've experienced this through other clients that I've dealt with, where they didn't really understand the intricacies of making sure that they reduce their consumer debt before they put on a mortgage as a responsibility on their plate. And, sometimes things just don't pan out the way we expect it. When we are drowning in debt, we don't have enough income to support ourselves, and then we have another responsibility of maintaining our mortgage payment. So it's so crucial to really sit down with a financial expert who's able to help you and guide you through your process in buying your first home. So thank you so much for clarifying that, Matt. So what is the rule of thumb when it comes to how much somebody can borrow? Is there, do you have to be earning a certain amount, or is there a maximum that you can get depending on how much you earn?
I always use an easy rule of thumb. It's not, it's not exactly correct. Each customer is different, as we said, and each situation is different. However, an easy rule of thumb to use is if you put down less than 20%, so you're applying for a high ratio mortgage, then easy rule of thumb is you probably can qualify for 5 times your income. Okay. So if you make 100,000 a year as a family income, then you will qualify for 500,000, most likely just under 500,000 mortgage. So 5 times your income. If you put 20% or more as down payment, you will qualify for 6 times your income. So if you make that 100,000 as a family, then you will qualify for a 600,000 mortgage. The reason being why you qualify for more if you put 20% down payment is because with a high ratio mortgage, which is if you pay less than 20%, maximum amortization is 25 years. So your payment is a bit higher. But if you put 20% or more, you can go to 30 years amortization. So then your payment is less. So then you qualify, your monthly payment is less. So you qualify for more mortgage to get. So this is an easy rule of thumb. You make whatever you make, multiply 5 times. Again, it could be a little bit less, a little bit more, depending on your own situation. Because we also have to take into calculation the property tax. If it's a condo, we have to take into consideration the maintenance fees, so it's going to reduce that amount. However, easy rule of thumb, less than 20% is 5 times your income. More than 20% down payment or more, then you qualify for 6 times your income.
It's so crazy that you say that, because I'm thinking about, the average Canadian is making about $45,000 to $50,000 a year. And so when you're thinking about that, if you don't have a family to pool your income with, it can be very challenging to get the reasonable amount of mortgage that you need to be able to buy a house in the Greater Toronto area. And so, what are some creative ways that you've seen people kind of come together and figure a way to be able to get proof for a mortgage when they don't have the substantial income to kind of prove that they can actually be able to get more of a loan?
So first and most is income. So we will always look at income as the main criteria for determining how much you qualify for.
Right.
However, let's say a person or a family, they don't make enough money. So then they can look for a co-signer, someone else that has good income that can come and co-sign the mortgage with them. However, we will also, that person will have to go on title of the property. So whoever is looking for a cosigner has to understand that that cosigner will go on that title of the property. They'll be an owner of the house. But also we will look at the liabilities, what debts the other person that's coming as a cosigner has, because that will also be included in the ratios when calculating how much the customer qualify for. But also there's other ways. So income is the most important factor in determining how much customer or the family is qualified for a mortgage. However, if the family qualifies for, let's say, 400,000 mortgage, and they're really looking for 500,000 mortgage or 600,000 mortgage, then in that case they can look for a co-signer. A co-signer is someone that they can come and co-sign the mortgage with them. However, that co-signer will have to go on title of the property, so they will be co-owners with the property with the customers that are buying the house. The customers have to be aware of that.
Right.
And it depends on how much income that co-signer, so that co-signer can get them over the hump and they can be able to qualify for that mortgage. However, the bank will take also, in addition to the income of that cosigner, they will take the debts of that cosigner. So the cosigner has their own mortgage, have their own loans and credit cards. All that will also be included in the equation. But in a lot of cases, the cosigner will help. The customers can come and ask us, would that help me with that cosigner? So after asking the questions about the cosigner, we can decide whether that is a suitable option or not. Also, it's very important that they can maximize their RRSP contribution by doing an RRSP contribution. Then they can get their credit tax benefit from the RSPs, and that can help them with having a little bit more down payment from the refund from CRA that they get from their RSPs.
Okay, got it. If you want to learn more about RSPs and how you can utilize them, especially for your first time home, please reach out. My contact information is below this video, and I can definitely help you understand and strategize around that, because an RSP is an excellent vehicle to utilize to help you reduce the amount of taxes you get back at the end of the year. It's also a great way to tap into for your first time home. And you can also potentially get a RSP investment loan that can help you with your down payment process as well. If you want to learn a little bit more about that, I would urge that you make an appointment with me, because obviously it depends on each individual what the solution is going to look like and how that strategy would play out. But there are creative ways to help you reduce the amount of down payment you have and potentially get into your home a little bit faster. So Matt, I wanted to ask, this term of refinancing your mortgage gets thrown around quite often. I would say, what does refinancing a mortgage really mean?
Refinancing a mortgage is taking your mortgage, and most likely it's increasing it. And you can have a lot of reasons to refinance your mortgage. For example, currently interest rates, as we said, is at all-time low. So it's a great time if you're already in a fixed mortgage and you're locked in at 3.5%, you can refinance, break your mortgage. However, you have to be aware that you're going to pay a penalty, but a lot of times it's worth it to break your mortgage and then get a lower interest rate right now. And you can, the customers can call you and me to determine whether it's beneficial for them to refinance their mortgage. Why customer, in addition to getting a lower interest rate, they would refinance? Because if a customer wants to renovate their home, if they want to consolidate some debts, they're paying a much higher interest rate and they have accumulated a lot of debts for whatever reason. Then they have a lot of equity in their property. Right. Customers can refinance their mortgage and take it up to a maximum of 80% of the value of their property. So, for example, if customers have a home that is worth 500,000, they can refinance their mortgage up to 80% of that 500,000, so they can refinance their mortgage up to 400,000. Right. In that case, if they had a 300,000 mortgage, they can increase it by 100,000, and they can use that amount to pay off their credit card debt. Let's say they have 20, 30,000 of credit card debt that they pay 20% on. Let's say they want to renovate. They want to renovate their basement. They want to upgrade their kitchen. They, for whatever reason, they can use that money to refinance to renovate or pay debts. Or for whatever reason, their kids are going to university and they want to be able to finance it. Or a lot of times also they want to contribute to investments. They say we want our money to work for us. It's not for every customer, but some customers saying, instead of my equity is sitting in my property, I want to take out this equity and I want to use it for investment. That's going to be up to the customer and up to the advice of financial planners like yourself to say whether that's suitable. But these are some of the reasons why customers can refinance their mortgage.
One of the things that I discovered in my journey when I was looking to purchase my home, someone had told me about the Heloc, the home equity line of credit. And they said, if you put down a 20% deposit for your down payment, a Heloc is something you can get potentially. For one, so this is like a two-part question. I want you to kind of talk a little bit about what does it mean when you put down 5% versus 20%, and what exactly is a Heloc?
So a Heloc is a home equity line of credit.
Right.
And you can only get a Heloc if you put 20% or more as down payment for your house. How the Heloc works is it could be a part mortgage and could be a part line of credit, or could be completely a line of credit. So the benefit of having a Heloc is, let's say you apply for a Heloc of 500,000. You can choose the breakdown of that 500,000. So let's say you can have a mortgage part of the Heloc as for a 5-year fix right now, let's say at a 1.7 interest rate. Right. And then you can have a line of credit portion of 100,000. So total is 500. And as you pay your fixed mortgage down, then the line of credit portion would increase automatically. So you'll have access, in other words, you'll have access to your equity in the property without having to reapply. The line of credit portion is fully open. You can pay it down in full at any time, and then you can draw it back. So it works like a glorified credit card. Mm-hmm. And usually interest rates, depending on each financial institution, it ranges from prime plus half to prime plus 1 interest rate. So it's a bit higher than your mortgage, but still a fantastic rate. And it gives the customers the flexibility of having access to funds for any purpose. Let's say they want to buy a car, they want to renovate their home, they want to do whatever it is that they need the money for. The Heloc and that flexibility gives them access to that money.
Okay, so just so that I can make sure that I understood this properly, and maybe the audience can understand through my questions, is that a Heloc is a mortgage that is broken into two different kind of components of a mortgage. One is a regular mortgage, and the other is a line of credit. So they're both piled into one, and you get to choose how much of it do you want on a regular mortgage and how much do you want on that line of credit. So for example, let's just say if you have a $500,000 mortgage in a HELOC, you could potentially have $400,000 in a regular mortgage and $100,000 in a line of credit. Am I following correct so far?
That's exactly right. So it's a secured line of credit, secured by the property, and that gives you again the flexibility. You can also, if you choose, you can start. Let's say you have a 500,000 HELOC, you can choose to have all 500,000 as a mortgage, and you start out with a zero line of credit. But having that HELOC option is, let's say 2-3 years down the road, you've paid down your mortgage by, let's say 30-40,000. You have that 30-40,000 that you've paid it down by available to you on the line of credit side. So it's very flexible, very good option. But again, you can only have the HELOC if you put 20% down payment or more.
And what are the benefits of having a HELOC? So I've put down 20%. Would you encourage me to get a HELOC, or would you encourage me to just get a regular mortgage, or does it really depend on the client?
It actually depends on the client. However, with most customers, they love that option. They would, again, having an access to funds without having to reapply. So that's an amazing thing. Unless a customer says no, thank you, I'm not interested, then that's fine. However, why not have that option to have access to funds? You never know. Like for example, right now we're in a pandemic, COVID-19. Some customers that have HELOCs, and for example, a member of the family have lost their job, so they to get them by for a few weeks or few months, then they can access funds that is available to them in the HELOC, in the line of credit portion, that they can draw it and have access for the funds. However, if they didn't have that and they go to the bank to apply for loan or for a HELOC at the time, they may qualify. However, if they had lost their job, they may not be able to qualify at that time. So it's good to have the HELOC just in case. You never know what the future, if you need it. Again, your car breaks down and you need a new car. Let's say your kids have grown up and they want to go to school and you want to help them out with some funds. So there's a lot of situation that is good to have a HELOC. If you qualify, again, you do have to qualify for it, and you have to have the proper down payment to qualify to get a HELOC. But it's, in general, is a good idea for the customers to have. However, if the customer says, no, there's no need for me, I don't see a need for it in the future either, then they can just have a mortgage.
And it's so crazy that you mentioned this, and as you're talking, this is what's kind of going on in my head. I remember before I got into this business and into the financial services sector, I had someone tell me, Harpreet, rich people never get rich by using their own money. They use other people's money to continue to build more wealth. And the fact that you just mentioned what a HELOC is just kind of just made me understand that wealth building process on a practical note. So when you do get a HELOC, you might not even use the equity, the line of credit as a part of your mortgage. You might just have it all in a regular mortgage. But the fact that something is there for you to use at any given time is the beautiful part of it. And the fact, just because you have a line of credit doesn't mean you need to use it. But let's just say, for example, you've built up enough equity inside your house and you have that portion available to you, and now you want to buy a new property. Let's just say the market crashes and this is the perfect time to buy a house, and you have that available to you. At least you now have access to money that can help you buy more assets in the future as well, which just kind of was like a moment of realization and a moment of wow. And I think this is so important to the education that we provide, understanding how you can unlock some of the things that are around you. This is why I constantly emphasize why it's so important to understand the rules of money, because once you understand the rules of money, you can help to leverage the things that are around you, the resources and the tools that are around you, to help you accumulate more assets. Because when you have put down 20% and you have that available to you and you need to purchase another property because it seems to be the perfect time, but you don't have enough of the capital, you have access to leverage your loans, which is amazing. And because sometimes we talk about refinancing to just consolidate debt, but also what about when we want to buy more assets?
Yeah, and Harpreet, the customers don't have to do it when they're buying. When we go back to your earlier question about refinancing, let's say they have a mortgage. It's not too late to switch their mortgage, or they can even go to their own financial institution, and they can refinance and get a Heloc. In that case, again, there might be penalties, there might be legal fees to increase their mortgage and refinance it. But if let's say someone is listening to us and saying, well, I wish I had that when I bought my home. It's never too late. You can refinance and switch your mortgage from a regular mortgage to a home equity line of credit, and then you can have the same advantages that we're talking about.
Right. Perfect. Perfect. So glad that you mentioned all of that. So are there any creative ways that we can save on mortgage? I know there might be no answer for this, but I still have to ask the question.
Well, we live in a digital world that all the information is readily available. We can literally shop around from the safety and the comfort of our own homes,
Right.
and find out what are the available interest rates at different financial institutions. So we have so negotiate your interest rate. Know what is best term for you, whether it's fixed or variable, as we mentioned earlier. Try to see your own situation. Maybe you're not gonna need a mortgage for more than 2-3 years. Then don't take a 5 years, because then you're gonna get into breaking your 5-year term. If you take a 5-year term and pay a penalty. See what's best in your own situation, and ask questions to your bank, to the mortgage specialist that you're dealing with. Find out what is the best thing that is suited, and our job is to give you advice and what is best for you, for in your own situation, that can give you the best benefit. But it's all about having knowledge, asking the right questions, and then determining together with the person that you're dealing with what is the best route for you, what is the best term, how many years of amortization, all that, whether to get a Heloc, not to get a Heloc, all that helps to give you the best outcome in your own situation.
Wow, you just shared so much great insight, Matt. I want to thank you so much for all your time, and for all of our audience. I hope that you got some great value from today's episode. There's just so much to learn. We've just really scratched the surface. We're going to dive deeper as we continue on with this channel, and we continue on with more seasons to really understand all the intricacies of wealth building and really decoding all areas of finance. And you can see, obviously home ownership is one of the greatest purchases that you'll make in your lifetime, most likely. And it's important to understand all the intricacies of what a mortgage is, how it works, and how you can make sure that you get the best option that's for you. And I really, really urge that if you are looking for more personal financial advice, reach out to me. My information is below this video in the description box. Don't forget to hit that like button, and don't forget to hit subscribe so you can get your latest information and knowledge around all areas of finance. But Matt, I want to thank you so much for your insight, your knowledge, and your wisdom. And thank you for being here on this beautiful day, sharing your time when you could be doing so many other things. But I'm sure that I know I appreciate it, and I know that others will appreciate your insight as well.
You're very welcome, Harpreet. It's been my pleasure.
Yes, thank you. Have a great day, and I'll connect with you soon.